Welcome back to Sip and Talk. You know, I've been thinking quite a bit, actually, about something we touched on last time.
Oh, yeah? What's that?
Micky's famed Trash 10 experiment. It really seemed to strike a chord, got a lot of listeners curious, like really curious.
I did, didn't it? It's got that that immediate hook.
Yeah.
Sounds a bit like something you'd cook up over drinks, maybe a bar bet.
Totally.
But, you know, underneath that, it's actually a pretty serious test of, well, market theory. Micky's not just throwing darts here.
Right.
His core question is pretty fundamental. If everyone agrees a company is, you know, just bad, does that collective negativity actually guarantee it fails?
Yep.
Or does it maybe create some kind of weird temporary buying opportunity?
It's a fascinating way to poke at market psychology, isn't it? Like, is the price super low because the company is genuinely doomed, reflecting the awful fundamentals? Or is it just, you know, driven by fear, by groupthink, maybe suggesting it could snap back eventually?
And wow, the timing couldn't be better for this chat. We're smack in the middle of this 2025 bull market. It's just roaring.
Oh, absolutely. U.S. stocks, Taiwan stocks, they're just flying. What are the numbers? Like plus 22% in the U.S.?
Yeah, something like that.
Yeah.
In Taiwan, even higher, nearly 28%, just in the first half of this year. It's wild.
Yeah.
And it's mostly driven by, well, you know, AI.
AI, yeah. And when you get that kind of like rising tide lifting everything, suddenly you see these young stock gods popping up everywhere.
Yes.
Bragging about how easy it all is. And it creates this feeling, doesn't it? Like relative deprivation. If you're not making 30% this year, you feel like you're getting left behind, like you're missing out.
That FOMO is real.
But Micky's whole philosophy, that core satellite thing he does, it feels like it's built specifically to fight that addictive get-rich-quick urge.
Precisely. And he has this quote, it's almost like a splash of cold water, which I just love. He says, if you can't assess the stock you're buying, you don't understand it. And if you buy what you don't understand, that's gambling.
Oof. Yeah. That cuts right through a lot of the noise, doesn't it? Especially now with all the overconfident speculators jumping in.
It really is.
So, okay, that's kind of our mission for today at Sip and Talk, right? We're going to dig into Micky's big question. Is making money in stocks really that easy?
Let's do it.
We'll use his ideas, his framework, and look at the data from this bull run to try and separate, you know, the real skill from just plain luck. Who's actually got the chops and who's just floating up with the tide.
Sounds good, but, you know, the usual quick reminder first.
Yes.
The important.
This isn't investment advice. We're definitely not experts giving tips here. We're just sharing some financial ideas, some frameworks, really, for you to think about, maybe challenge, for reference only.
Absolutely. Critically think, folks.
Yeah.
Okay, let's unpack this whole system. Starting with this Trash 10 contrarian experiment and like how it connects to his main investment thinking. So this term Micky uses, the dartboard market. That's such a great way to put it. It is, isn't it?
It basically means things are so hot that, yeah, theoretically, you could blindfold a monkey, let it throw darts at the stock listings, and it probably still pick some winners.
It sounds kind of ridiculous, but, you know, the structure of this 2025 market, it actually feels a bit like that. And a big reason is concentration.
Concentration, where the money's actually going.
Exactly. It's not spread out evenly across, you know, thousands of companies, not at all.
And the numbers on that are pretty stark, aren't they? In the U.S., it's all about those 7 titans of AI.
That's right. NVIDIA, Microsoft, Amazon, Meta, Apple, Google, Tesla. Those 7.
Just 7.
And get this, those 7 stocks alone, they accounted for something like over 60% of the S&P 500's entire gain in the first half of the year.
60% from just 7 companies. Wow.
It's huge concentration. So if you just happen to be loaded up on those specific 7 names, well, you look like a genius, right? You're giving TED Talks. Yeah. But if you owned, say, a nice diverse basket of the other 493 stocks in the index, you just look, okay, good, maybe. Not godlike.
And it's similar in Taiwan, right? Super focused.
Very much so. It's all about the AI supply chain, chip manufacturing, server stuff, cooling systems, silicon photonics, very, very narrow focus.
Okay, so you've got this intense concentration plus tons of money sloshing around high liquidity. And that creates that specific illusion, that dartboard market feeling that like anything that isn't total garbage is going to the moon.
Exactly. And that is the perfect breeding ground for probably the biggest psychological trap in investing.
Which is?
Confusing beta with alpha. Oh, man. If you take away one thing today, it should be understanding this difference. It's absolutely critical.
Okay, let's slow down then. Define these for us. Beta first.
Okay, beta. Fundamentally, Beta is the profit you make simply because the entire market is going up. It's systemic risk return, the classic rising tide lifts all boats effect.
So like if the whole ocean level rises, your little boat goes up too, even if it's got holes in it.
Pretty much. If, say, the NASDAQ 100 index is up 25% for the year, and you just bought a basic ETF that tracks the NASDAQ 100 and you made 25%, well, that's beta.
You didn't do anything special.
Nope. The environment, the market itself carried you. It's essentially market luck, or just, being invested in the right system at the right time.
Okay, so beta, market luck. Got it. What's alpha then?
Alpha is the opposite. Alpha is the excess return. It's the profit you get because of genuine skill, maybe deep insight you had, or really smart stock selection that beats the overall market.
Okay.
So if the NASDAQ 100 is up 25%, but you, maybe by picking some stocks outside those big seven, managed to get a 35% return, that extra 10%, that's your alpha. That's the premium for your skill, your insight.
Right. And the trap, the attribution fallacy, is when people, especially new investors, mistake that easy beta gain.
The rising tide.
For actual alpha.
For their own personal brilliance.
Exactly. And it gets turbocharged by something called the Dunning-Kruger effect.
Ah, yes. The know-it-all effect. Kind of. In a roaring bull market, people with, frankly, low competence, often the newest folks in the market, they make quick, easy money purely because of those huge beta gains. And then they mistakenly think they're amazing. They vastly overestimate their own ability. They genuinely believe they've cracked the code. The market's easy. I'm a genius. They become those young stock gods.
I think probably a lot of us listening felt a little bit of that Dunning-Kruger buzz, maybe back in the post-2020 run-up, that feeling like you couldn't lose.
Oh, for sure.
It's kind of humbling but important to hear Micky basically say, yeah, that was probably just beta doing the heavy lifting for you.
Micky sees it very clearly. He points out that the people who lack real skill but are just, willing to buy stuff that dart throwers, they actually get rewarded, heavily rewarded in this kind of market.
Rewarded for just showing up, basically, not for being smart.
Right. Rewarded for participation, not insight. And that's the real danger here. This kind of bull market doesn't actually weed out the unskilled. Not yet, anyway.
Okay, so if the market isn't kicking out the unskilled now, during the party, who is getting eliminated? Because the market's always selective, right? Even when it's going up.
Oh, absolutely. It's still selective, but the selection mechanism shifts. It becomes focused entirely on discipline and survival. Micky sees 3 groups getting knocked out, even while the music's playing.
Okay, group 1.
First, people using excessive leverage, borrowing way too much money. Often they're chasing those easy beta gains, trying to juice them up. But then the market just hiccups. Doesn't even have to crash, just a decent correction. And boom, margin calls. They get wiped out instantly. Leverage is the absolute fastest way to blow up.
Yeah, we've all seen those stories. So Micky's first lesson isn't even about profit. It's just survive.
Survival first, always.
Okay.
Second group, the emotionally driven.
The panic sellers and the FOMO buyers.
Exactly. People who get super greedy when everything's rocketing up, maybe leverage up even more.
Yeah.
And then the second there's a dip, they completely freak out. They panic sell everything, often right at the bottom.
Turning what could have been just temporary volatility into a permanent loss of capital.
Precisely. Lack of emotional discipline. It might be an even faster killer than lack of knowledge, honestly.
Okay, leverage victims, emotional wrecks. What's the third group getting eliminated?
The third group is maybe a bit slower to get eliminated, but it happens. It's those who refuse to learn, who refuse to adapt when inevitably market efficiency starts to creep back in.
Meaning when the easy beta ride ends.
Yeah, when that phase runs out and stock prices start needing, actual fundamental reasons to go up again. If you haven't spent the bull run developing some genuine alpha skills, some real understanding, you're just going to slowly, painfully give all those easy gains back.
And Micky's whole system, this core satellite thing, is basically designed to make sure he survives that transition.
That's the idea. Built to survive the cycle.
Okay, that sets things up perfectly. He's building this defense against getting caught up in the hype, against that psychological overconfidence. Which brings us neatly to his core satellite framework.
Right, so Micky's strategy, the one designed to keep him disciplined and help him survive those cycles we just talked about, is this core satellite approach. And, it's not like he invented it. It's a pretty standard strategy, actually. A lot of institutional investors, big funds, they use it.
Why? What's the appeal?
Because it strikes this really nice balance. It gives you long-term stability on one hand, but also allows for aggressive, focused experiment on the other.
So it's like the responsible way to play with fire. You keep most of your money safe, and just use a little bit for the risky bets.
That's a great way to put it. The structure is really the key. The core, that's the big part. Usually like 70%, maybe even 80% of the whole portfolio.
Okay, a bulk of it.
Yeah. And that money goes into really broad, super diversified things. Think low-cost index funds, ETFs, right? Stuff that tracks major markets like the S&P 500 or maybe the whole global tech sector.
The classic set it and forget it basket. And the job of the core is pretty clear. Stability, capturing that beta we talked about.
Exactly.
Yeah.
The core is basically Micky admitting, look, over the long haul, the market's pretty darn efficient. It's really, really hard, even for pros, to consistently beat it.
So she just joins it.
He says, okay, I probably can't beat the market consistently with all my money, so I'm just going to ride the market with the vast majority of it, with that 80%.
Okay, wait, let me push back on that a little. If Micky's goal includes hunting for alpha, and he's obviously a smart guy thinking deeply about this stuff,
yeah,
why settle for just matching the market with 80%? Isn't that kind of like admitting defeat before you even start?
But see, that's the clever part. It's not really admitting defeat. It's about psychological security. It's risk management at its core.
How so?
By locking in those beta returns on the huge majority of his capital, he basically removes the fear of total ruin. If his high-risk bets, his experiments go totally sideways and blow up.
Which they might.
Which they absolutely might. But his long-term financial security, it's still okay because the core is solid. And that discipline, that lack of fear, allows him to be much more objective, much more emotionally detached when he's managing the risky part, the satellite.
Okay, I see. So the core guarantees his survival.
Mm-hmm.
And surviving lets him stay disciplined with the risky stuff. He's not making decisions out of fear.
You got it. Okay, so that's the core. Then you have the satellite portion.
Yeah.
The smaller piece, maybe 20% or 30%.
The fun money.
Yeah. Well, the aggressive money. Yeah. The alpha-seeking part. This is where he puts his individual stock picks, maybe some niche thematic ETFs focused on emerging trends he likes, or these high-risk experiments like the Trash 10.
And this is where it gets really interesting, because the Trash 10 isn't him just like randomly buying penny stocks hoping one takes off.
Not at all. It's framed as scientific verification. He's using this small, discretionary chunk of money, importantly, money he's mentally prepared to lose, to test a specific, pretty sophisticated hypothesis about how markets behave at the extremes. The primary goal isn't even making money initially.
It's not. What is it then?
It's seeking knowledge. It's verification. He wants to find the edge.
Yeah, edge between?
And he's trying to figure out exactly where the line is between a genuine contrarian investing opportunity, buying something everyone hates but that might recover, and a permanent value trap.
Ah, the dreaded value trap.
Right. When a stock is universally despised, price in the gutter.
Yeah.
Micky's trying to scientifically determine, is the market just having a temporary emotional overreaction that he can exploit for alpha? Or is the market actually correctly pricing this thing for a slow, painful death due to, like, permanent structural problems? That's the line he wants to map out.
And that loops right back to his harsh quote. If you can't assess the stock you're buying, you don't understand it. Even with these Trash 10 stocks, he can't just buy them because they're cheap. He has to dig in.
Yeah. He has to understand why they're considered trash. Deeply. So he can maybe spot that tiny glimmer, that potential catalyst for a turnaround that everyone else is missing.
Okay, so this brings up that idea of the secret sauce, right? The mindset, the part you can't just copy from a book.
Exactly. Because, look, anyone can learn to read the charts, the K-lines. Anyone can pull up a financial statement and calculate a PE ratio. That's all quantifiable knowledge. It's easily replicated.
But Micky's real edge, his potential alpha, comes from the other stuff.
It comes from his tacit knowledge. The stuff you can't easily write down or quantify.
What's tacit knowledge in investing?
It's things like, okay, you can read 100 books about market crashes, but you cannot download the actual emotional discipline it takes to not hit the panic sell button when your portfolio is bleeding red ink.
Yeah, that gut feeling, that experience.
Or the experience to know when the best action is actually no action, when to just sit on your hands. Or the psychological strength to stick with a contrarian idea when every single headline, every talking head is screaming that you're an idiot. That's tacit knowledge.
It's like reading the instructions for baking a perfect souffle versus actually knowing from experience exactly when to pull it out of the oven so it doesn't collapse.
That's a perfect analogy. Yeah. Exactly. And this leads to what we could call a personalized statistical edge. The Trash 10 isn't just about picking stocks. It's Micky's very specific personal stress test. He's using it to build and refine his own unified system of knowledge and action.
Tailored just for him.
Tailored to his specific tolerance for risk, his emotional makeup, his discipline level, and crucially, his circle of competence. Buffett's idea about only investing in things you truly deeply understand.
So if you just gave Micky's exact trash 10 list to someone else,
it probably wouldn't work the same.
Because if their emotional wiring is different, or if they don't have that big, stable core portfolio providing that psychological backup, they'd likely bail on the experiment at the first sign of trouble, abandon it at the worst possible time.
Almost certainly. And the ability to actually execute a sound strategy consistently, especially when things get scary, that is the ultimate form of alpha.
Okay, let's shift gears a bit and talk about Micky's skepticism, his sort of mathematical pushback against this whole easy money idea. He brings up this thing called the mathematical paradox of easy wealth.
Right. The simple math that looks so appealing up front.
Yeah, like if every single trade you made gave you a nice, clean, plus 10% return, well, after just 10 trades, you'd have compounded your initial money by 2.59 times. Sounds like a guaranteed path to riches.
It does sound amazing. But it makes a huge assumption. It assumes zero volatility, zero losses, just perfect, smooth compounding. And the real world, as we know, is way messier than that.
Definitely not smooth.
This really highlights a crucial difference that trips up a lot of new traders. The difference between the arithmetic mean, the simple average, and the geometric mean.
Geometric mean, that's the one that accounts for compounding, right?
That's the one. The arithmetic mean is just, add up all the returns and divide by how many there were. Simple average. But the geometric mean, that tells you the actual rate of return that connects your starting capital to your ending capital, including the effects of compounding over time. And here's the kicker. Volatility. Ups and downs.
Yeah.
That is the absolute enemy of long-term compounded growth.
Okay, give us the cold, hard numbers, the reality check Micky talks about.
Okay, simplest example. Let's say you make 2 trades back-to-back. Trade 1, you win 10%. Nice. Trade 2, you lose 10%.
Okay, so average return is 0, right?
Yeah.
Plus 10 and next 10, you broke even.
Arithmetically, yes, the average is 0, but think about your actual money. Start with $100. You win 10%. So now you have $110. Great. Then you lose 10%. But you're losing 10% of $110, not $100. So you lose $11.
So you end up with $99.
Exactly. Even though you had a 50-50 win-loss rate and the percentage gain and loss were the same size, the volatility means your compounded capital actually went down by 1%. Because 1.1 times 8.9 equals 0.99.
Wow. Okay, that's a sobering bit of math. So just breaking even on average isn't enough if there's volatility.
It's not. This mathematical reality means real long-term success demands consistency and ideally pretty low volatility. If your strategy involves lots of big swings, those quick 10% wins often followed by 10% losses, the geometric average, your actual compounded return is likely negative over the long run.
So short-term trading isn't just about being right more often than wrong.
It's much more complex. It's closer to a really high-level probability game, and it's super sensitive to sequence risk, meaning the order in which your wins and losses happen matters hugely. It's way, way harder than the young stock gods make it sound.
Okay, so risk isn't just the chance of losing money on one trade. Risk is also volatility eating away at your ability to compound wealth over time.
That's a huge part of it, yes. Now let's talk about the tools people use. Micky is, let's say, highly skeptical of people who rely only on technical analysis, especially just looking at K-lines, candlestick charts.
But those charts look so official. Those little red and green candles, the patterns, they seem scientific.
They look appealing, absolutely. They promise simplicity in a complex world. Technical analysis basically rests on 2 big assumptions. 1, that history repeats itself in markets, and 2, that the price reflects all available information.
Okay.
And look, for really experienced traders, these patterns can be useful signals, part of a bigger toolkit. But Micky points out a massive flaw. The real world is infinitely complex. He uses the phrase scenario A divides into A1 to A infinity, meaning a simple visual pattern on a chart like a cup and handle or an evening star formation just cannot possibly account for all the other things going on. The fundamental health of the company, political shifts, new regulations, economic changes. The chart doesn't know about those.
And worse than just being incomplete, those patterns can actually be faked, especially in less liquid stocks.
Oh, absolutely. This is a significant issue, particularly in some markets, maybe smaller cap stocks where Micky often operates. He talks about the DHU.
DHU. Sounds ominous.
It's a Chinese term, basically means the big households or the whales. These are powerful individuals or maybe smaller, nimble institutions that have enough capital and coordination to, well, mess with things.
How do they mess with things, like manipulating the charts?
One common tactic is called painting the tape.
Painting the tape. Okay.
It involves these large players conducting a series of trades, often wash sales, basically buying and selling shares back and forth between accounts they control just to create artificial trading volume and make specific technical patterns appear on the chart.
Why would they do that?
To lure in retail investors. They might make it look like a stock is breaking out strongly, lots of volume, positive chart pattern, gets everyone excited.
So the chart looks beautiful, screaming, buy, buy, buy.
Exactly. But it's actually a carefully constructed trap set up by the IU so they can then dump their shares onto all the excited retail buyers who rushed in based on the fake pattern.
Ouch. That's brutal.
It is. So Micky's point is pretty stark. Relying solely on simple K-line patterns is incredibly unreliable, especially when, there are sophisticated players out there actively trying to exploit the predictability of people who follow those patterns blindly.
Okay, that makes sense. And that leads right into the next myth he likes to bust. The idea that the retail crowd pushes price. You hear this constantly, especially with meme stocks, right? If we all just buy and hold, we control the price.
Micky is deeply, deeply skeptical of that. His classic comeback is just, there are too many people smarter than you in the market.
Simple and direct.
He always comes back to market structure. Who actually moves prices, especially for bigger stocks? It's the professional traders, the huge institutions, the giant quant funds. They dominate the trading volume. They have way faster access to information, way more computing power, armies of analysts.
Well, retail investors are
more scattered, often more emotional, maybe focused on short-term pops or just following trends they see online.
So retail isn't driving the bus for the most part?
Generally, no. For most stocks, especially larger ones, the retail crowd is often the source of liquidity. They're the ones the big institutions trade against when they want to build a large position or get out of one. Their collective actions rarely determine the overall direction. In fact, Micky often observes that extreme retail sentiment acts more like a contrarian indicator.
Meaning, do the opposite of what the crowd is doing?
Often, yeah. When the retail crowd is absolutely all in on something, euphoric, talking about it nonstop everywhere you look, that's very often the precise moment the smart money of the institutions have finished accumulating their position and are starting to look for the exits. They're selling to that euphoric crowd. Okay, so to really get inside the thinking behind Micky's Trash 10 experiment, we kind of need to understand this tension, this ongoing debate between two big ideas in finance.
Which are?
The efficiency market hypothesis, or EMH, and behavioral finance.
Okay, EMH first. That's the classic one, right? The one Micky seems to reference.
Yeah, EMH, largely developed by Eugene Fama, Nobel Prize winner for it. The basic idea is that stock prices always reflect all available information instantly.
All information.
Well, there are different versions. Weak form, semi-strong, strong. Micky's specific comment, good news is already reflected, bad news is already reflected. That lines up really well with the semi-strong EMH.
And semi-strong means?
It means that the current stock price reflects all publicly available information. Financial reports, news, analyst ratings, economic data, all of it is already baked into the price. So according to this view, if Micky's Trash 10 stocks are indeed trash, their super low price is actually the correct efficient price reflecting that reality.
But wait, if the market was perfectly efficient like that, then finding alpha beating the market through skill would be impossible, right?
Exactly. Pure EMH implies alpha shouldn't exist or it's just random luck. So what challenges EMH?
Behavioral finance.
Bingo. Behavioral finance comes along and says, hold on, markets are made of humans, and humans aren't perfectly rational calculating machines.
That's why not.
It acknowledges that our emotions, our cognitive biases, things like confirmation bias, where we only see evidence supporting our beliefs, or loss aversion, where losing $100 hurts way more than gaining $100 feels good, and just plain irrationality cause market prices to regularly deviate from their true fundamental intrinsic value.
So prices can be wrong sometimes.
Behavioral finance says yes. It suggests markets can suffer from, say, overreaction to bad news, pushing a stock price way lower than it deserves, creating a potential buying opportunity, or maybe underreaction to genuinely good news.
Okay, so Micky's Trash 10 experiment is like a real-world test between these two theories.
It absolutely is. He's testing. Is the market's extreme negativity towards these 10 stocks a rational, efficient reaction, like EMH suggests? Or is it an emotional, behavioral overreaction, like behavioral finance suggests, that he might be able to profit from?
That clarifies the experiment's purpose beautifully. And it leads right into this really critical distinction for anyone trying to buy cheap stocks.
The difference between a genuine contrarian opportunity and a deadly value trap.
Right. Everyone dreams of being that brilliant contrarian who bought at the absolute bottom just before it turned around. But reality is most people trying that end up buying something that just keeps going down. They step right into the trap. How do you tell the difference?
Okay, let's define the value trap first. This is a stock that looks cheap on paper, Low price to earnings ratio, maybe low price to book value. All the classic value metrics look good.
Seems like a bargain.
Seems like it. But in Micky's words, it's deservedly cheap. The low price isn't an opportunity. It accurately reflects that the company is facing permanent structural decline.
Like what kind of decline?
Think about industries whose whole business model just became obsolete, like blockbuster video stores when Netflix streaming took off, or maybe Kodak when digital cameras destroyed the film market, or companies today that just completely failed to adapt to the AI revolution, or maybe they're facing huge permanent new costs because of carbon regulations or shifting global politics.
That kind of structural damage? It's really hard, maybe impossible to reverse.
Extremely hard. And the data actually backs this up. Morningstar did a study looking back over the last decade or so, simply buying stocks based only on a low PE ratio. The classic cheap signal actually lagged way behind buying high-quality companies with stable growth, even if those growth stocks looked more expensive.
So just being cheap doesn't mean it's a good investment. Cheap can just mean bad.
Cheap can absolutely just mean bad. Okay, so if that's a value trap, what makes a cheap stock a potential contrarian opportunity?
This is the golden ticket, right?
This is what Micky's hunting for. It's a stock that's cheap for temporary reasons, not permanent ones. Maybe there was some huge indiscriminate market panic, like the whole market crashed and dragged this company down with it, even though its fundamentals are okay.
Or maybe a specific temporary issue.
Yeah, maybe a temporary legal problem or a product recall that got tons of bad press but is actually fixable. Or, and this is crucial in today's market, maybe it's suffering from the neglect effect.
Neglect effect.
In a market like 2025, where all the money, all the attention is hyper-focused on those 7 AI giants, funds might just completely ignore perfectly decent, smaller, non-tech, maybe legacy industry companies. They're not selling them because they're bad. They're just not buying them. They're neglected.
So they get cheap not because they're dying, but just because nobody's paying attention. The spotlight is somewhere else.
Exactly. And the key to profiting from a true contrarian opportunity, the thing that separates it from a value trap, is identifying some kind of potential catalyst.
A catalyst? Like what?
Something that could make the market suddenly notice the stock again. Maybe there's hidden value on the balance sheet the market missed. Maybe a new CEO comes in with a brilliant turnaround plan. Maybe an unexpected merger offer. Or maybe the company successfully pivots its product line in a way the market hasn't recognized yet because it's too busy chasing AI.
Okay. So the Trash 10 experiment, which you said is likely these kinds of neglected, non-tech legacy stocks, it's perfectly timed because of that massive concentration in AI we talked about earlier.
Precisely. The experiment becomes a litmus test for the market's health and direction.
How so? What do the results tell us?
Well, if the experiment works, if Micky finds that on average, his basket of Trash 10 stocks starts to outperform the broader market, especially the non-AI parts of it.
What would that mean?
It could signal that money is finally starting to flow out of those super crowded, ultra-concentrated AI leaders. It suggests investors are starting to look for value elsewhere, in the forgotten corners of the market. It could mean the rally is broadening out, which is usually healthier.
Okay, that's the success scenario. But what if the experiment fails miserably? If the Trash 10 just keeps sinking?
Then it confirms the opposite. It suggests the structural shift is real and maybe permanent. It would imply that those legacy non-tech companies are being correctly priced for long-term decline, and that the real economic growth, the real beta gains, are structurally locked into those AI dragon heads for the foreseeable future.
So Micky's little experiment is actually testing the entire economic narrative, the old economy versus the new tech dominance.
In a small, personal way, yes. It's his way of probing the edges of that narrative. You know, when you really break it down, Micky's whole approach, it kind of moves beyond those traditional rigid finance models like pure EMH. It feels closer to something called the adaptive market hypothesis, or AMH.
Adaptive market hypothesis, what's that?
It's the idea that market efficiency isn't some fixed constant. It actually changes. It adapts based on the current market environment, who the participants are, how they're behaving. Efficiency waxes and wanes.
Okay, so the market isn't always efficient or always irrational. It's dynamic.
Yeah, exactly. And Micky's strategy seems built for that dynamic reality. His true alpha, his real edge, isn't necessarily claiming he can always predict the market's next move. It's in his highly personalized, adaptive risk management system.
That personal edge again, that customization. He basically says, look, I know I can't consistently beat the whole market.
So I'll capture the market's return with my core.
Right. But, he continues, I will use this smaller satellite part to test my own ideas, my own hypotheses, my own limitations, within specific niches where maybe, just maybe, I can find an edge.
And the absolute genius of that core satellite structure, the thing that makes it all work, is the psychological buffer.
That safety net from the core.
Yes. Those steady, reliable beta returns coming from the big 70-80% core portion. They provide the essential psychological foundation. They give them the confidence, the stability to handle the potentially wild swings in the satellite.
It lets him take those calculated risks, those fat tail risks, with things like the trash 10.
Without constantly living in fear of blowing up his entire account. If one of the trash 10 stocks goes to zero, it hurts, sure, but the core is still there, chugging along, protecting his long-term base.
That patience, that ability to stick with a hypothesis, even when it looks bad temporarily because you're not terrified of ruin, that's a massive advantage most individual investors don't have.
It's huge.
Yeah.
Okay, so let's quickly recap the cognitive blind spots, the mental traps that Micky's whole philosophy seems designed to help him avoid. These are the things that take out less disciplined investors all the time.
Okay, blind spot number 1.
Ignoring risk and, importantly, costs. People get so fixated on the potential upside, the big win.
Yeah, the Lambo dreams.
Right. And they completely ignore or downplay the small, constant drags on return. Things like commissions, taxes, sure.
Yeah.
But also slippage.
Slippage. Explain that.
Slippage is just the difference between the price you thought you were going to buy or sell a stock at when you placed your order and the price you actually got filled at. In really volatile stocks, or ones that don't trade much, low liquidity, that difference can be surprisingly big.
So those little costs add up?
They add up. And when you combine those hidden costs with the ever-present possibility of just one or two really large losses completely wiping out a whole string of small wins, well, that easy money evaporates fast.
Okay, blind spot 2. Listening to the crowd too much.
Over-reliance on the herd, absolutely. Following hot tips, jumping on bandwagons because everyone else is, it's usually a recipe for disaster. Micky knows. Like we said, by the time an investment idea is being shouted from the rooftops on social media or is the cover story on a magazine,
the smart money is already heading for the door.
Very likely. The institutions, the pros, they've probably already done their buying much earlier, much quieter. If you're hearing about it from everyone, you're probably the exit liquidity.
Ouch. Okay, and the final big mistake. The killer flaw.
Lack of a system. Lack of discipline. It's just basic human nature, unfortunately. We have this tendency to snatch profits too quickly on our winners. We get scared the gains will disappear.
Yeah, nobody ever went broke taking a profit.
Right. But you might go broke taking profits too small and too soon. And conversely, we tend to let our losers run way too long. We refuse to admit we made a mistake. We keep hoping it'll come back.
Hope is not a strategy.
Definitely not. A successful, repeatable investment approach needs strict, unemotional rules. Rules about your target win rate, about your risk-reward ratio on each trade, like only taking trades where the potential profit is, say, 3 times the potential loss, and rules about how much capital you risk overall. Micky's using the trash 10 partly as a way to constantly test and calibrate his system, to enforce that discipline on himself.
So it really comes down to this. The final test, the ultimate measure of success, isn't hitting some crazy high percentage return in 1 year.
No, not at all.
It's about staying in the game, longevity.
That's it, exactly. The market, fundamentally, operates on probability, not certainty. There are no guarantees. The successful investor, the one who survives and thrives long-term, is the one who manages risk relentlessly. They structure their approach to make sure probability stays tilted in their favor over many, many cycles. And this brings us right back to Micky's core piece of advice, the quote that really sums up his entire philosophy.
Let's hear it again. It's a good one.
Investment is not about proving you are smart. It's about prolonging the time you are not eliminated from the market.
Boom. That really is it, isn't it? True alpha isn't about hitting home runs every time. It's about not striking out. It's about staying in the game long enough for the math, for probability and compounding to actually work for you. Survival, enabled by that stable core.
And his core satellite setup is the practical engine that helps him achieve that survival, navigating the emotional roller coaster of these crazy dartboard markets.
Wow. This has been incredibly illuminating, really digging into Micky's experiment, but also the bigger financial theories and market dynamics driving things in 2025.
Yeah, hopefully it helps put things in perspective. So to quickly recap for you listening, remember, a lot of the success you're seeing in this bull market is likely high beta, just market luck, pretending to be alpha genuine skill. Micky's whole core satellite approach, it's a really disciplined, almost humble way to operate. He's trying to find his own specific areas of alpha through careful small-scale experiments in the satellite.
The trash 10.
Right, while simultaneously acknowledging, hey, the overall market is probably pretty efficient most of the time, and capturing that reliable beta with his core ETFs.
So the real takeaway, the successful path for most of us, probably isn't trying to copy Micky's Trash 10 picks or anyone else's hot stock tips.
Probably not.
It's the much harder, much more personal journey of figuring out your own investment core values, your own risk tolerance, your own circle of competence, through ongoing testing, reflection, and maybe small experiments of your own. You have to learn when it makes sense for you to be aggressive and, maybe even more importantly, when to pull back and play defense. That's true personal investment wisdom.
Well said. And maybe that leaves us with one final kind of provocative thought for you to chew on.
Lay it on us.
In a global market that's increasingly dominated by AI trading systems, by complex algorithms, by high-frequency trading, all of which theoretically make markets, especially for large, heavily watched stocks, more and more efficient every single day. Where should regular retail investors with limited time and resources even be looking anymore to find the next pockets of genuine market inefficiency? Where might the next generation of alpha opportunities hide?
Ooh, that's a big question. Is it in tiny microcap stocks? Is it in completely ignored, boring, non-tech sectors? Or maybe, is the answer just to forget about alpha altogether, double down on cheap beta ETFs, and call it a day?
Something to think about, for sure.
Definitely. Well, as always, we've tried to keep this objective, just laying out the facts, the frameworks, hopefully sparking some critical thinking.
Yeah, we really hope this conversation helps you navigate this pretty exciting but also potentially treacherous bull market with a healthy dose of skepticism, a focus on discipline, and like Micky says, an eye towards survival.
Absolutely. Thank you so much for tuning in to Sip and Talk. Please do subscribe wherever you get your podcasts. This really helps us out. And hey, definitely check out our old friend Micky's YouTube channel. It's called Micky to Life.
Yeah, it's great. Less finance, more fun over there. He's got hilarious memes, liquor tastings.
And his latest European travel vlogs are up too, I think. Always entertaining.
Good stuff. All right, until next time then.
See you soon.